So as mentioned, the bond market already taking all of this as a sign the Fed will be a lot less aggressive in the months to come. But is the market getting ahead of itself? Joining me now is Michael Darda. He's MKM Partners chief economist and chief macro strategist. No one else I'd rather talk to today, Mike, going into the long weekend especially. So as you see this, is the U.S. economy slowing dangerously? Are we in recession? How soon is the Fed going to need to pivot to rate cuts, do you think?
Yeah, it's a pretty confusing picture, Kelly. So I do think we're slowing, but that's a good thing. If we were growing way too fast and the primary risk and concern was high and elevated and sustained inflation. And so we need to slow. Slowing is a good thing, not a bad thing. Now, it is kicking up some fears of recession. But I think we need to be very clear about what a recession is. It's simply not 2 down quarters of GDP. That's sort of the shorthand that everybody believes. But technically, a recession is defined by the NBER, the National Bureau of Economic Research, that defines business cycles for the U.S., as a period of falling production, sales, income, and employment that usually lasts more than a few months. If you want a singular indicator to define a recession for the U.S., it really shouldn't be GDP. It probably should be the unemployment rate. If you look back at every single recession since the end of World War II, the unemployment rate has risen at least 2.2 percentage points from pre-recession trough to post-recession peak. And where are we right now? 3.6%. I just brought up the data. We're essentially at the cycle lows. Now, that might change in the future, but that is a prediction, not something that's already occurred.
Yes. And again, the first half, the weakness in real GDP is really because of inflation, not because demand is slowing. It's because demand was too hot. It all went into nominal. It all went into inflation. It didn't leave us anything left over. We've pointed this out sort of as the week has progressed, a lot of people say fine on the labor market, but that it's a lagging indicator. And what would you say in response? I mean, there are leading ways to look at the labor market. I mentioned jobless claims. We get, hiring and layoff notices, that sort of thing. The mood seems to be that we are going to abruptly shift into a sharp downturn in, I suppose, hiring and a jump in the unemployment rate.
Right. Well, certainly, you can't eliminate that as a risk factor. The level of the unemployment rate is a lagging indicator, but the 12-month change is about a perfect coincident indicator, perfectly coincident. So, if people are focused on GDP, you can focus on the unemployment rate. If you're looking at year-over-year changes, it's actually coincident instead of lagging. You mentioned jobless claims. They're off the lows, but they're still at incredibly historically low levels and kind of going sideways now. So we can continue to watch that. But I would just try to remind the viewers, we have some very good news here on the front edge of the inflation trade that's rolled over quite hard. Inflation expectations at the 5-year horizon are down more than a full percentage point now from the late March levels.
Yeah.
That's pretty significant. That's good news. That means the Fed is regaining credibility. They're getting traction with their rate hikes and with the initial movements in the balance sheet, which have effectively just started. So if the Fed doesn't have to do all that much and it can get inflation to come down, I mean, that's a good story, not a negative story.
And
we've also seen yeah, absolutely. Oh, go ahead.
Well, as I want to hear the rest of your thought, and maybe you could just end it by saying what you think the implications are for the market, because you were very concerned earlier this year, rightly so. We've had a massive valuation reset. The Fed is catching up now. The market is adjusting. Are you bullish for the back half?
Yeah, I think the market's attractive here. We came into the year where the market was stretched on valuations relative to earnings and interest rates, but also relative to liquidity. We've had a big liquidity slowdown, but the market has dropped more than 20% year to date. So this is not the time to get negative on equities. The time for caution was earlier in the year when everyone was bullish, not now after a 20% slide. Consider this, your average recession bear market is just over 30%. So if we're already more than 2/3 of the way there, why get negative now? It doesn't make any sense. If we avoid a recession, there's probably a lot of upside. And if there is a recession, the bulk of the recession bear market is behind us now anyway. So this is not a time to be negative on equity markets. We'll see what the macro data does. But I fear that a lot of retail investors are just waking up to the fact that the market's down a lot and they're going to sell at the lows. And that does tend to happen over and over again.